Hello and good afternoon. Welcome everybody to this webinar this afternoon. On behalf of Brentis Wealth and our entire staff and everybody listening and watching this afternoon, a very warm welcome. And especially to our guests who will be adding their insights to the discussion. We have Terence Corrigan, who's a project manager at the South African Institute of Race Relationships, SARR. It's a liberal think tank that's been around for more than 100 years. And Terence has been doing a lot of work on expropriation without compensation, and he's got some very strong views as to what that can do to the economy. And thereafter, we have our fund manager, one of our fund managers, Tony Bell, who manages the IP Global Opportunity for Brentis clients. And by the way, Tony has just won yet another award for his fantastic performance over a 10-year period, 5-year period. It's the top fund management company or fund in South Africa out of all the big names. And Tony's been beating them with his IP Opportunity Fund, which is a 2 billion rand fund for Brentis Wealth clients. And he's got some views on the local market, the offshore market, and how he's playing the Trump trade. Is it an impact, or can it have an impact on financial markets? But let's come back to the topic today, the threats to your investments, threats to your wealth. And we're referring to things like expropriation without compensation, which is now law. We're thinking like national health insurance, that is now law. There's the Bell Act, and there's the bigger issues surrounding the so-called National Democratic Revolution and how it can impact on your investments. But in order to answer your question, I need to go back 10 years in time. In other words, 2015, 2014, when we had President Zuma or ex-President Zuma in charge, thankfully, we had the Gupta years in full sight, in full flight, fleecing the country, hundreds of billions of rands, leaving the country. We had the beginning of state capture. We saw the effects of rollouts of BEE, tightened BEE securities. And at that time, ladies and gentlemen, Brentis, as a smallish boutique company, started looking at all of these issues and analyzing and trying to predict what impact it could have on the wealth of our clients. And I refer to wealth in the form of stock market investments, unit trust investments, pension funds, residential property investments, commercial property. And in order to do so, we held a series of seminars countrywide, and some people watching this might remember, they might have been there. We call it South Africa Quo Vadis. In other words, where are we going? And we had esteemed speakers like Mike Sushler, the late Mike Sushler, as one of our guests. We had Dr. Frans Cronje, who's still very active, our political analysts. We had Richard Calland, another analyst, and myself and other speakers. And we were playing with a couple of scenarios, saying that things are not looking well for South Africa, and we recommend that people consider investing offshore to protect their wealth, which, by the way, was legal, which it still is, and that people could, at that stage, take out 1 million rand through the single discretionary allowance, and as much as 10 million rand in terms of applying at SARS to take out 10 million rand. And we also recommended that people increase the offshore asset allocation within the pension funds, retirement annuity funds, and discretionary share portfolios. And we gave a lot of reasons why we thought it needs to be considered. So this is the background. We went out to the market and we started saying, guys, you need to take your money offshore. And we said this aggressively. We said this on various media outlets, radio programs. But for our sins, we were lambasted by the press and commentators, friends, colleagues, And we kept on saying, guys, look at what's happening to the country. As a country, we have just been downgraded from a positive investment rating within 2 to 3 years. By 2017, we were 3 levels below investment rating in terms of our foreign credit rating. In other words, we were in junk status. We had state capture. We had the Zuma presidency. We saw the first signs of the collapsing of South African railways, state-owned enterprises, harbors, etc. And against that background, we advised our clients. We said, guys, there's a problem coming our way. You should take some money offshore. Fortunately, a lot of people listened to our advice, because I need to stress, as a company, Brenthurst operates on only one principle. We work for our clients. Our clients pay us, nobody else, not the asset managers, not the insurance companies, not the banks. Nobody pays us but our clients, and they expect us to give the best possible advice, and we take that very, very seriously. So our advice at the time, ladies and gentlemen, was take some money offshore. And as you can see, as an example of an article more than 10 years ago, where I was absolutely lambasted by Rapport and Ryk van Niekerk, who's the editor of MoneyWeb, saying I'm talking absolute rubbish. This country is not heading towards a collapse. And in fact, things are looking good, and the outlook was looking better. And it was based on emotion. It was not based on fact. In fact, Financial Mail at one stage called me Dr. Doom, as I've been telling people, take some money offshore. And it wasn't only a South African story. It was also that the American stock market was doing very well on its own. The technological boom was in full flight. Companies were listing, companies were growing. The Apples, the Amazons, the Microsoft, Teslas, Facebooks were making huge amounts of money for their investors. And the only way that you, as a South African investor, could get access to these markets was to take some of your money offshore and put it into the American market. And we all know by now that was a very, very good piece of advice. And those people have built their wealth. Here's another example. Africa is not on the verge of a precipice. And, again, our views were not in favor. We lost a lot of friends. We were suddenly not invited to golf days and nice dinners, etc., because what we were recommending was not in the interest of what I call the vested interests, who have other objectives in mind. We could also see it. Now we can look back and saying, was our advice correct? And what does the lost decade in terms of investments like for the average South African? And you don't need to be very wealthy to listen to this and think you're not impacted. Everybody, from the smallest investor to the biggest investor, has been impacted by this lost decade in terms of wealth generation for South Africans as a nation. And in fact, the more I've researched this topic, the more I am shocked at how poor as a country we've become. I'll quickly show you a couple of slides which shows you the extent of our problems. 15 years ago, our debt to GDP ratio had been declining for about 20 years, and it was about 24-25%, albeit on the back of a very attractive commodity boom. But under Trevor Manuel and previous finance ministers and a president, there was, from this fiscal discipline in the country, our debt was down to 25%. And for that reason, the rand was 6 rand 50, it was 7 rand. Money was flowing into the country. The country was being managed financially responsible. It all changed under the previous President Jacob Zuma, especially under Finance Minister Pravin Gordhan, who was called by certain people as the best finance minister we've ever had. I disagree. He was a socialist, and he opened the taps, and as you can see, the end result, that 15 years later, South Africa's debt to GDP ratio is in excess of 75% now, and that excludes the debts of the state-owned enterprises and Eskom. So the trajectory is terrible, and that's why we're sitting with a ratings problem. We're sitting with government that cannot balance its budget because it's run out of capacity to take on more debt, so it has to do other stuff, and that's why we can't deliver a budget. Our debt ratio is too high for an emerging or a developing country. Here's some more statistics just to ruin your afternoon, ladies and gentlemen. On the left-hand side, you can see, and this is following on yesterday's GDP numbers, this is now 24 numbers as well, our real GDP per capita, which strips out the inflation numbers and the population growth numbers, shows that South African economy today is actually smaller in real terms than 2007. Now, that is a shocking statistic. And this has been happening for the last 10 to 12 years. And every time we have a number like that, the government comes out and with statements like we're cautiously optimistic and the upturn is coming, etc., etc. Well, my commentary on that is with the current strategy, with the current management, it's not going to happen. It's like trying to pull yourself up while standing in a bucket. You're not going to get it right. Our employment rate, ladies and gentlemen, is the highest in the world. It's more than 30%. This chart is actually quite generous towards the situation. It's about 34%. And inequality in terms of the Gini coefficient is the highest in the world. So on purely objective, measurable statistics, the South African economy is in a terrible space. No matter what the fund managers and the economists and the bankers tell us, we're in deep trouble. Only last week, the World Bank released a document which was scathing about the management of our economy, and they're normally very, very diplomatic. They're basically saying that BEE plus corruption, plus red tape, plus strangulation of the economy is not working, and we need to change. And I haven't noticed much commentary about that in the traditional media. It's as if it has not happened. There's another example of how deep we are in trouble. That is the South African Purchasing Managers Index. It measures the activity in the industrial space. And that's been declining since the peak in 2007-8, when we were still building railway lines and building soccer stadiums. Since then, yes, there was a global financial crisis, but the trend has been down steady but surely, to the extent that the manufacturing sector as a percentage of the economy is now about 14-13%, whereas it was 25 again. Now we can see it. You just travel through certain industrial areas. It's derelict. Factories are empty. The towns are emptying for various reasons: Eskom, roads, water. And that, again, leads to lower unemployment, increase in crime, and all the things that counts against us as a country. And you can only blame the ANC, ladies and gentlemen. The rest of the world has recovered very dramatically. They've grown their economies. Our economy, even at 1%, if we're generous, is 2.5 percentage points below the average for the world, and emerging markets is even higher. So our economic management has been a disaster under the ANC. Another aspect that we must focus on is that our income tax base is shrinking. And here is a chart that shows you that more than 50% of all personal income tax is paid by 45% of the upper end of the taxpayers. In effect, 70,000 taxpayers in that bracket pay almost half of all income taxes. And just this week, I saw some reports by commentators saying, well, we need a wealth tax to tax those rich people. Well, my reply to that is those people are not very wealthy, but they're also smart, and a lot of them can move their money and their businesses if they come under pressure. So our tax base has not grown, it's been shrinking, and government has loaded all indirect taxes in order to squeeze more juice out of the lemon. So against all of that background, what has made me extremely angry over years is the outrageous pronouncements from big institutions like Old Mutual. They come and they get published in authoritative journals, saying that now is the time to invest in South Africa. Here's an example. There are many, ladies and gentlemen. I'm not going to bore you, but here is the most outrageous one. In 2018, Ramaphosa came into power. This company went around to all its advisors and brokers and said, now is the time to invest in South Africa. And they predicted very confidently that the JSE will be the best stock market in the next 5 years. While we know that in the next 5 years, i.e. 2018 to 2024, the JSE was one of the worst in the world, but nobody talks about this. And this is a company, like others, forever trying to talk up the market, but it's not working. Now, here is an example of what I'm talking about. This is a 15-year picture of the investment returns of, in dollar terms, of the world markets, the S&P 500, and that's not even a very aggressive index, versus emerging market down there. So emerging markets, South Africa, even did worse, grew in total over 15 years by about 35%, which is 2% per annum, whereas the S&P 500 has been growing at 9 to 10% per annum. Can you see the difference in wealth for somebody invested locally versus somebody invested overseas? And here's another example. In rand terms, the last 10 years, the JSE versus the MSCI World, the one in green, then the red one is S&P 500, NASDAQ is the black one. Look at the rand numbers today for a 10-year investment starting on the same day. Your JSE will give you about 2.2 million rand in your pocket today, and a lot of people think, so that's quite nice, I've made some money. MSCI gives you 4.5 million, S&P 500, 5.5 million, and the NASDAQ almost 9 million rand in your pocket over a period of 10 years. So everyone invested in our stock market has experienced a dramatic decline in their purchasing power of their money. You experience it when you buy dollar-denominated goods, like computers, cell phones, when you pay for Netflix, when you fly overseas, hotel expenses overseas. Anybody who travels overseas comes back and they just say, my golly, things are expensive. It's true, but it's because we've become so poor. So there's a 10-year picture. You won't see this published in the mainstream media. They just refuse to publish it. It's not in the interests of their bosses or whatever. Here's it in a tabular format. The Satrix Aussie Index on over 10 years, 8%, and the other benchmarks significantly better. What this table tells me and everybody who looks at it is that in every year, over 10 years, 7 years, 5 years, 3 years, 1 year, even 6 months, the JSE underperformed the 3 accepted benchmarks in the world. Bottom line is we are getting poorer. Your purchasing power of your investments is shrinking in a very, very dramatic way. Lo and behold, the same website, MoneyWeb, which attacked me 10 years ago, had a piece last week was saying, well, the smart money actually left 10 years ago. That's exactly what we were trying to tell people. So they're now very belatedly admitting the big money has left the JSE, the smart people, the well-informed people, and the guys who could read the charts, but ordinary investors, I'm afraid, have suffered as a result of this biased reporting. I will give you an example, ladies and gentlemen. This is the assets under management for Coronation Asset Management Company. It's a very good company, predominantly South African investments in dollar terms. Their assets, in other words, your money has not grown in 10 years. In fact, your money now buys 30% less in dollar terms. This is what I'm talking about. This graph illustrates very, very well the poverty-inducing policies by the ANC. Ordinary investors are now starting to appreciate it and feel it in their pockets, but this is a reflection of what has been happening. Pardon me. And that applies to all asset management companies in South Africa. Their assets are shrinking, and it's not their money, it's your money. So it is shrinking in value. Opposed to that, that's the inflows of money and the growth of money in the United States. Just to give you a comparison, over a 12-year or a 13-year period of time, the growth of people who invested in American pension funds or products have shown enormous growth. They have kept pace with inflation in dollar terms. They can buy more things. They have become wealthy. We have become poor. That's what that chart tells me. Here is my second last slide on residential property. Also, this is a financial catastrophe for most people. The media has stopped talking or writing about it, unless they talk about the Cape market, which is still buoyant. But on average, this is the FNB banking groups, their inflation-adjusted price increases of residential property, which they have under their control, or the bonds that they grant, which is about a third of the market. It shows you, this goes back to 2018, but it goes back much further. The dark lines below the zero means that your property is declining in value relative to inflation. So most people, there was a little blip just after the COVID crisis, but since then, your property in real terms has dropped in value by about between 3 and 4% per annum. And over this period of time, the real inflation-adjusted value of your property is down by about 28%. Okay, call it 30%. So it buys 30% less in rand terms that it, and this is, again, a consequence of 10 years of no growth, consequence of a total collapse. Johannesburg, Pretoria, our cities are being collapsed by the ANC, cadre deployment, BEE, the theft, rampant theft, but we are all paying the price in this, in the form of lower prices for the assets that we hold. So that's the background, ladies and gentlemen. So we are talking how to protect your wealth. I'm going to hand you over to Terence Corrigan, who's going to be giving his views on expropriation without compensation. The IRR and many other think tanks have warned that this is disastrous for economic confidence in the country, and it can lead to further downgrades, outflow of money. And we'll immediately hand over to Tony Bell, who talk about his fund, how it's beaten inflation. And then you come back to me with a couple of pointers, what to do if you believe what I'm saying, and what we think the next 10 years can be. So straight over to Terence, and thank you for listening for me.
Okay, Magnus, thank you very much. Let me just put my slideshow up. Okay, are we good with the vision? Okay. Now, I've called my talk The Political Economy of Property Rights in South Africa, and I've chosen that term very deliberately. Political economy is a kind of branch of political science, which is fundamentally what I do, which looks at the intersection between politics and the economy. Regrettably, I'm not an investment guru like Magnus. Otherwise, I'd probably be a much wealthier man. However, I do understand, I think, how these things fit together. And as Magnus has said, I've spent the last couple of years working on the question of property rights, or as it's kind of been entered the public mood swing, expropriation without compensation. Right. So I want to put three propositions on the table just to frame our discussion. The first of these is that property rights are human rights. This is often lost in South Africa. I'm old enough to remember the debates around the Constitution, 1990, the interim Constitution, pre-1994, going up to the main Constitution, and there was a sizable body of opinion that said, well, property rights are something for rich people. They should be protected by ordinary law, but ultimately we need a strongly interventionist state because we need to focus on things like civil liberties, but then also uplifting society's poorest. But property rights are intrinsic to a successful growing economy. I remember a couple of years ago, actually, when I was a lot younger, I worked at the Institute of International Affairs at Wits, and speaking to one of the economists there, he put it very succinctly: no country has ever successfully developed without property rights, and used the term developed. In other words, went from poverty to prosperity. And I would also like to add, going back to the first point here, that property rights are foundational to political freedom. A couple of years ago, I did a paper on this, the question of property rights as a human right, and you can actually plot this on a graph. Countries that are that have high levels of civic freedom, of political freedom, that are democracies, invariably intersect with a high degree of economic freedom. There are a couple of exceptions, but they are exceptions. If you want your democracy to endure, you have to accept the ability of people to own their stuff. One of the crudest reasons for this is very simple. If the government can take away your means of livelihood, the government has you in a twist. And you can see this in totalitarian economies around the world. You don't necessarily have to throw someone in prison. You can simply restrict the ability of that person to work, to earn a living. China at the moment has the social credit system, which performs it almost virtually. Are you a good citizen? And if you are not, well, your kids don't get to go to the good schools, things like that. So one of the reasons why I suspect that I'm on this panel is because of this, the Expropriation Act number 13 of 2025, which small detail was actually apparently signed shortly before Christmas last year, but our president did not choose to favor either his nominal coalition partners or the country with a heads up that this had been done and was coming, and then inexplicably chose the day after coming back from Davos, where he had declared South Africa to be open for business to spring it on the world. Now, this has been a part of the what we at the Institute have called the EWC agenda. It was to some extent overshadowed by the very considerable debate that took place over the question of the constitutional amendment. But this, to my mind, was actually a much more important intervention, because this sets the legal parameters with which expropriation, the taking of property by the state, can happen in a practical day-to-day sense. If the state comes after your house or your farm or your factory, this is the legislation that they will use. We have a new regime on the table. Now, we've been told there's only to see here, folks. Perfectly standard. Doesn't really move the needle. Just updates South Africa. Well, we have three concerns. First of all, there's the definition of compensation. Or actually, I'm sorry. I think I misspelled it. The definition of expropriation. In terms of the act, expropriation is defined as effectively as a two-stage process. The state will take, but then must take ownership. It is possible within this framework for your property to be taken, but not to be technically taken over by the state as its own property. In which case, you may have lost your property, but you have not been expropriated, and therefore you do not qualify for compensation. Now, this seems a bit of a head-scratching concept to a lot of people, but let's remember, this is what happened with mineral rights, and this is what happened with water. This comes off a constitutional court decision from around 2013, where the no compensation with the taking of custodianship of mineral rights was called into question. And this is what Justice Mogoeng wrote, and this was something that was very, very attractive to the powers that be. Secondly, the process for expropriation. Now, this is complicated, and I don't want to get caught in the weeds, but essentially, by our assessment, this places the property holder in very much in a subordinate position, where you are going to be, let's say, encouraged to settle sooner rather than later. Yes, court, you can approach the court, but by the time you've done that, your property has already possibly been taken. Given the way the courts work, it could be a long process, and at the end of it, you may or may not receive anything back, and of course you have to fund that from your own pocket. Anybody wishing to see our arguments in more detail, if you go into our site ir.org.za, you can see our submission to Parliament on this, or you can simply Google my name. I've written about this in a few places. And thirdly, there is the determination of compensation. Now, EWC, expropriation without compensation, is a nice, simple, easy to use phrase. And we tend to see this in terms of you have an asset, the government takes it, you have no asset, and you get no money. In point of fact, the compensation is that's a little bit of a red herring. Yes, there are instances where the Act says that your property may in certain or land specifically may be taken for nil compensation. Just like if your boss refuses to pay you, you may receive a nil paycheck. We can try that one out. But what I would like to put to you is that the way that the compensation provisions are structured means that invariably you are likely to suffer some expropriation without compensation in terms of a very extensive list of discounts that the state can give itself, compensation provisions that allow for it to reduce the amount owing. And also remember that, contrary to what has been reported about this, there is not a closed list of 4 or 5 factors around which nil compensation will apply. It says, not limited to. So there we go. I think that in sum, what this does is it sets up a system which is weighted in favor of the state, which may not have been a particularly significant factor if indeed we were dealing with a sort of Nordic or Scandinavian fantasy that many people seem to assume the South African state to be. We are dealing with the South African state as it exists. Now, here's the other thing. This is about the taking of private property by the state, and it is not about land. I think I have blood in my throat from saying this so often. There is no such thing as the Land Expropriation Act, and I've seen this put out by prominent political commentators. I've seen this put out with those words capitalized as if this is the official name of the act. It is not. This is an act that refers to how the state will take any form of property, and expropriations are designed like that. Land may be one asset class, but it is certainly not the only one. But at this point, I would just like to segue a bit. Why has land, or should I perhaps say the land, featured so prominently? Because land is a key political idiom, and this is why I wanted my talk to be about the concept of political economy. What does land do? Well, in South Africa, land is, as our president once said, the original sin: history, grievance, justice, belonging. Many of these things are meshed together. Land, or the land, often you have to attach that article. It's a political symbol. It's something that people can get very excited about, because it is something that is that touches their sense of history. Interestingly, though, land has never been shown, and I want to go back to 1994, has never been shown to be a major political issue for people. In fact, I'm reliably informed that when one of the ANC's pollsters was approached in 1994 and asked, why did the ANC not campaign on land? They said because they had regular polls coming in which showed what people were concerned about, and land just never featured. The PAC, by contrast, campaigned on land as their major issue under 0.5%. South Africa, and when I say land here, I do think we need to differentiate slightly. Farmland and agrarian land is simply not a concern for some people. No matter how often this is raised in Parliament, or how often this appears in news columns, pointing out often distorted figures about who owns what. South Africa is now 66% urbanized. The figure is not going to change. Where there is some land hunger, it's about urban land. It's about housing. And that creates but that is a whole different conversation. That's about essentially why our cities have to start going up rather than out. But this emphasis on land, it feeds it feeds the ANC's national democratic revolution and what I would call a broader liberationist framework. The idea that who controls the land is in control of the destiny of the country. Now, this has then become a prime source of political mobilization. But this is the EFF's election pitch: our land and jobs now. And I love this poster because it shows the different impulses. The EFF talks this liberationist game, but it has to very clumsily append and jobs. So yes, on the one hand, it's making a political pitch about land, but it knows that this is not something that resonates. Most, with the exception of, let's say, a very small clique of ideologues and perhaps a small group of well, I would not, maybe not small, but a very manageable community of people who might want land for productive purposes. South Africa's population, which I emphasize, is now 2/3 urbanized. There is a massive body of evidence that says its concerns are jobs. People want to move to cities, have access to amenities, earn wages, and see their children in a position to rise to a middle-class standard of living. Now, the trajectory of policy. How does this play out practically? What we're talking about with the Expropriation Act and with the direction that policy in terms of property rights has taken is that it is about assets. It's about property, not just land. And it is also, as I say, about value and not just assets. Now, this doesn't make things less serious, it makes them more serious. The direction of government policy for decades has been about greater state intervention. There was a period in the 1990s where I remember Nelson Mandela saying privatization is the fundamental policy of the African National Congress. But that went out the window very, very quickly. For various reasons, partly because the ANC comes from a left-wing quasi-Marxist ideological tradition, but also because of the success and rapid industrialization of the kind of East Asian developmental state. There's been a long-standing attraction to the to an interventionist, or what's been called a developmental state. How's that worked out for us? Well, not very well. And what I would like to put to you is that this has not manifested itself so much in the taking of assets for the state, although this has been done from time to time. But for the most part, the sheriff hasn't come to grab your house or your farm or your 4x4 or your classic pioneer. What they have focused on is expropriating value. Now, Magnus talked at great length about how your investments aren't performing, and I would like to say that it is precisely this that explains a good part of it. What government policy has been about is about perhaps relinquishing ownership for the most part, but wanting to take an ever greater proportion, or at least control an ever greater proportion of the economic value, either for itself or for a particular beneficiary group. So, for example, let's think empowerment policy, BE requirements, public procurement, employment equity, sectoral charters, industrial policy, master plans, localization, premiums, licensing that is dependent on having the appropriate partner. And sometimes that may come with an informal demand that it's not just the right kind of partner, it's this particular partner who needs to be cut in. Agricultural policy, what I think a lot of people don't realize is that the idea that a beneficiary of land reform will automatically get ownership is not government policy. It hasn't been for the better part of 2 decades. The state land lease and disposal policy of 2013 actually made it very, very clear that in order to qualify for owning something that one received through the redistribution framework, which is different from restitution, but I don't want to get too much into the weeds of that. You would need to basically farm that to the satisfaction of an official for 50 years before you might have an option to buy. There was a case where the government actually went to court to try and renege on an agreement made 20 years previously, to sell a successful black farmer the state-owned farm that he was working on. We've seen new water regulations, which try to tie your ability to access water resources to racial and empowerment conditions. Labor policy, basic conditions of employment, sectoral bargaining. You're in it whether you want it or not. Public sector wages. Now, let me just say that I can be a bit of a squish here. I'm not opposed to paying civil servants a great deal of money if they are delivering value, but the context of a declining or effectively shrinking GDP, I really don't think this can be sustained. And of course, the national minimum wage, which according to some research not conducted by ourselves but by a unit at UCT, says costs something like 250,000 low-skilled jobs. Health policy, well, we go back to the 90s, prescribed minimum benefits, the dispensing fee limits, and now national health insurance. Now, often I find myself having to explain this, that the national health insurance system is effectively about creating a state monopoly. It's not necessarily the case, from my understanding, that you would want to nationalize your Netcare hospital, but you would want to expropriate a large part of the value of it, and that it'll be a take it or leave it. This is what we're going to pay. We can deprive you of your license to operate if you disagree, and we might insist that in order to participate in this, you have the right people cutting poor share deals. And then education policy, I think probably one of the most debilitating. First of all, it's a little more abstract, but there's been the school capture phenomenon, which in a way I think is worse than anything that happened under state capture. This has involved literally the degradation of of school environments, particularly those schools that service South Africa's poorest people. The trading in post, the allowance of education unions to exert undue influence, and latterly the Basic Laws Amendment Act, Basic Education Laws Amendment Act, which again was signed by the president over the head of the education minister, and I'm very happy to say that I believe he was making a point about who was in charge. And I think Dr. Franz Crinier has made the point here that this is not just about language, not even predominant, but it is about centralizing control, which makes it more and more difficult to actually address the problems that beset our education system. If you consider that kids in Vietnam, perform maths at something like 10 years ahead of what we do, you get to see the problem. I also remember Tito Mboweni in the 1990s talking about the skills revolution. Well, we're nowhere near it. So, what does the Expropriation Act mean? Well, I would like to say the key issue is not specific clauses. It's not the nil compensation, although I think those, cumulatively are important. But it is about the increased state discretion in property expropriation. And I think this is indicative of a broader mindset. The state will, what Clem Sunter once called, Pretoria will provide, and the open-ended demand for redress. And this is not to say that I don't think that we do not come from a very tortured history. Simply that this is now running into an economic wall, and unfortunately, we do not have the sort of efficient state machine that might be able to mediate such a suite of demands. And I think there's also been a general disregard for economic growth imperatives and for maintaining the current coalition government. I want to say this to everyone here: for a coalition government to work, it needs to do two things. First of all, every party needs to take bespoke benefits to their constituencies, and the government as a whole needs to be able to deliver for the country. Too much of the narrative in South Africa is about people must do it for the good of the country. That's just not how it works. It's not how it works in any context. And I think that the way this has been shaking out, and I say this as someone who's quite excited about the possibilities, is that the ANC and President Ramaphosa specifically have seen this as a means to tame, discipline, and ultimately destroy their coalition partners. with a firm eye on how they can perhaps by default and by disillusioning the opposition support base, return with a majority. And I think that is being done to the detriment of the country as a whole. There's also a strong strain of policy romanticism. And this came across my Facebook feed, and I actually had to share it because I thought it was so delicious. How South Africans benefit from the Expropriation Act? Well, we get land reform and equitable ownership, improved public infrastructure. We get economic growth and job creation, enhanced food security and rural development, affordable housing and reduced overcrowding, fair and transparent expropriation processes, support for public interest projects, water conservation, empowerment, and increased economic participation for marginalized groups. So in other words, as long as the state has sufficient ground scope to take your things, we can get all of this great stuff. I really don't understand why we have certain interests in South Africa, if this is true, that are saying, well, the act is really bog standard international practice, because surely then everyone would want an act like this that can enable them to take things and get enhanced food security and rural development. The idea that this is this is under the auspices of a state that has not shown itself to be overburdened with considerations of probity doesn't seem to enter into it. But let's let that slide. So here's my little scenario. What happens with the Expropriation Act and the land question? And I'm just focusing on land here. Well, I think there are three things. First, three things might be plausible. First of all, that there's a continuity. The act is rarely used. Farmers trust state assurances. There might be occasional abuse, but overall little changes. That would, I would say, probably be the best overall case. But as I say, this act functions very much like a loaded firearm. Put it in the wrong hands and it can be very damaging. Second scenario is instability, where the act is partly used for redress and transformation. What you see happening there is that there's a number of demonstration cases. Large operators start rushing to conclude BEE deals. Banks become a lot more hesitant about putting money in. Small farmers in particular are squeezed out. Agriculture survives very much as an agribusiness, but with subdued growth. In other words, it's not attractive to do business. And unfortunately, I think this is the path that much of our economy has gone. And the third is failure. The act leads to mass land seizures. Then there's a new act that brings all land under state control. You see, this is what I said about the definition of expropriation. There's a new law introduced that says it's called the Land Access Act. I see there's actually something that seems to have popped up from the Minister of Land Affairs, which may well be foreshadowing it. In terms of which the state takes custodianship of everything along the lines of mineral rights. You require licenses to operate your farm. For that, you need appropriate BEE partners. You have a class of bureaucrats overseeing this who really don't understand agriculture. There's massive rent seeking, and agriculture is effectively crippled. South Africa ends up as a food importer. But let me reiterate: this is about property and not land. So what could this mean, for instance, for buildings, infrastructure, and immovable property? There's an open question. If something can be taken for nil compensation, could this apply to the buildings on it? What about, we could start with derelict halts in the center of the city, but would a housing development in Sandton maybe not be an interesting prospect, or perhaps a large campus of, let's say, one of Joburg's large suburban churches. Mining, gas, petroleum resources. Well, we've seen draft legislation that tend in this direction. Pension funds and financial assets. As things become somewhat more constrained. Healthcare funds and facilities. Maybe for NHI to work well, we'll need 30% of each hospital group. Private security companies. We saw legislation that wanted foreign companies to divest themselves, I think 50%, 51% of their equity. Artworks and cultural artifacts. Would that Tinus de Jong in your lounge not perhaps look better in the mold-ridden basement of the Joburg Art Gallery? Who knows? But as I say, remember, property, not land. Now, I'd just like to pick up on something that Magnus showed, and this is particularly interesting. Towards the end of last year, I pulled some numbers together. These are World Bank figures, looking at how South Africa performs in relation to the world. These are low income, middle income, and high income countries. Now, South Africa, the sort of gray line, enters the 1990s, well, virtual civil war, but slowly manages to claw its way up, gets to about 5% in 2006, 2007, and then goes on a gradual decline. And over the last decade, it's been scraping along at about 1%. This, however, was the period of the middle income country. This is globalization working. This is where India, where China, where Mexico came out and shine. And look at those numbers. We're above 8% in some cases, at least double South Africa in every respect. But there's more. High income countries find it more difficult to grow because they, have larger economies, often smaller, less scope for the population to expand. We underperform high income countries for the most part, and low income, those are the subsistence places, are also doing better. In other words, South Africa has been a global laggard by any means of comparison, particularly in the second half of this graph. Let me show you what's behind that. Gross fixed capital formation or investment. And I remember Mark Mobius saying South Africa has to make South Africa more attractive, not just for foreign investors, but for domestic investors. Here as well. South Africa, the light blue line at the bottom, scrapes along. I mean, now we are barely getting to 15%. And the National Development Plan was talking about 30% annually. In fact, I think that we only kind of reached 30% at some point in the 1960s. I'm not even sure if we made it there, but we haven't hit the 20% mark since the commodities boom. Now look at our middle income peers. Here we're skating above 35%. It's bonanza time there. How about our high income countries? Well, they're doing better, considerably better. These are, as I say, these are countries that where you need a great deal more investment to actually, to actually get these numbers. And then low income countries also not performing too shoddily. Now that tells us the problem we're in. People are simply not willing to put their money into South Africa, at least not in the sums we need. How much of that has to do with EWC specifically, and how much just with a generally hostile approach to business, with a policy mix that just makes no sense. And then there's this. The talk of the town, President Trump. Things I think are about to get very, very bumpy for South Africa, and I think this is fundamentally a political question, but also that intersection between politics and economics. South Africa, since the Mbeki presidency, has been playing a very dangerous, or maybe not dangerous, but I would say a hazardous game of brinkmanship with the United States, making clear that it sees itself as a revisionist power, that it wants to team up with other countries of the global South, and increasingly with countries that are directly hostile to the United States to challenge its standing. Now, that in itself might be something that the country could get away with if it had the diplomatic nous, the diplomatic core, and the global heft to provide a counterbalance. In other words, as long as you're damning American influence, do you have the diplomats going and knocking on offices in Washington to say, don't take this all too seriously? Do we have the scale of economy that can say, well, we're a valuable partner, irrespective of differing on politics? Do we have the system of alliances where people would actually want to have our back? And I just don't think we do. So, when I saw that President Ramaphosa had given his name to that article in Foreign Policy alongside the Prime Minister of Malaysia and the President of Colombia, my heart sank. Not so much because because of the content, although we can get into an argument about that, but because the Malaysians certainly have played a very careful diplomatic game for decades. They know that their position in Southeast Asia and the intelligence cooperation they have with the United States, and to some extent the military cooperation, makes them a valuable partner of the Americans. In other words, they can kind of say these things and get away with them. I don't think that South Africa can. South Africa has also been talking up its relationship with the global South, which I think is a very reasonable direction to go in. But in practice, its economic relations have remained largely focused on its traditional trading partners, particularly for those high-end goods and for the investment capital, and also for the our exposure for government bonds. I do, love President Trump or hate him. I do think that he stands to be, in some respects, quite a transformational president. And I'm not sure that South Africa is either prepared for the ride or fully appreciates just how bumpy it might be. So, 3 considerations I'd like to put to you. Will the threats to property rights continue? I had hoped that with the advent of the government of national unity, this would be retired somewhat, but I don't think so. I think it is really hardwired into the ideological DNA of the ANC, and I think the ANC still has not accepted that it may not be a majority party. If they continue, South Africa has no chance of escaping the low growth trajectory. And when I talk about property rights, yes, I'm talking about the Expropriation Act. Yes, I'm talking about the problems of a mismanaged land reform, but I'm also talking about the appropriation of value. I'm also talking about things like BEE. I'm also talking about public procurement and the amounts of money that flow through that. I'm also talking about the inefficiencies that come through that, and I'm talking about the employment equity impending employment equity scheme that will see non-compliant firms slapped with fines big enough to shut them down. And I'd also like to just add, and this is where I get back to the question of political economy, what does this imply for the endurance of South Africa as a constitutional democracy? Now, I'm not an economist, I'm not an investment advisor. And I can tell you this question keeps me up at night. With that, I want to thank you for your kind patience, and I look forward to engaging and to answering any questions you might have.
Terence, thank you very much. We can pose the questions on the screen, and we'll try and answer them at the end, but thank you very much for that. We hand you over to Tony Bell now. I'm trying to tell you.
You just got one.
Sorry.
Magnus, can you hear now?
Now we can hear you loud and clear. Just a little bit louder. Thank you, Tony.
Okay, perfect. And you can see the slides. All good. Okay, and I'm going to try and put a little bit of framework to what Trump is doing, and try and help you understand what the whole issue is around tariffs, why he's addressing it so aggressively, and where that takes us from a financial market point of view. And then I will conclude with how we have positioned the fund in this current environment. Just get a pointer. There we go. Okay. It's very pleasing. Magnus met me at in Mully Point about 10 years ago. We had a very nice lunch together, and he listened to my story and said, I like the way you think. I'm going to put some client money into the fund. And it really has been a most engaging journey. The fund in question in rands is line A, the sector average line B. So in rough terms, the fund has delivered roughly twice the return of the global flexible sector average. And pleasingly, clients have been rewarded along the way. In terms of Magnus's introduction, the question really is, have you accrued value in dollar terms? And so the chart also takes the fund's performance since inception, and it translates it into dollars. That's line A, and the comparable global flexible sector is line B. Again, we've done a little bit more than twice the sector average in dollars. Magnus also mentioned in communiques that we have started up a dollar global macro fund. This is run under the auspices of my plan. All of these funds are run under the auspices of my plan. And this is a dollar fund, offshore money, that is run out of Guernsey. And it really mimics the IP Opportunity and My Plan Global Macro Fund. They're all part of the same group. From ThinkCell's perspective, we have the pleasure of managing all of them, and it has itself got off to a very good start. What's important from a fund manager and client perspective is consistency. So what the chart shows you is relative to the sector average, how we've done for every month of every year since inception. And in essence, what you want to see is that the dots and the squares are above the diagonal. And it talks to the philosophy that we've built into the process of looking to capture upside, but aggressively manage downside risk. And downside risk has certainly come into focus at the start of this year, and we'll unpack that as we go through. A lot of talk about NVIDIA. Yes, NVIDIA has been in the fund. It had been a top holding for a while. And on the chart, you can see that over the past year and the past 5 years, NVIDIA sure has compounded well ahead of the market average. The market average is the S&P is depicted by the gray colored line or the block. And you can see that in the portfolio, there's quite a significant selection of shares from Eli Lilly, Apple, Hermes, Netflix, Intuitive Surgical, that have all done incredibly well for clients invested in the portfolio. And there's a very simple reason why. If I go back to Terence's comment, I think in 2013, I made a fairly politically incorrect statement that South Africa doesn't have a growth problem, it's got a capital allocation problem. And the name of the game globally, ladies and gents, is about capital allocation. If you have a look at the MSCI World Index, it's divided into around 11 sectors. Of those 11 sectors, in 8 of them, the top 5 companies control 80% of the capital allocation and the margin. And so you're dealing in a world where many of these companies are bigger than all of the companies put together on the JSE. And it's testament to the fact that capital has reallocated where return opportunities exist. The style of the fund, is a no surprise fund. You should never find anything in the fund that worries you. We manage risk position sizes very aggressively, as we'll get onto. But I thought just to give you a sense of the fund positioning and the style relative to the average, we are looking for companies that have higher growth prospects. They don't always come with high dividend yields. If you're looking for a high dividend yield fund, this is not it. The companies that tend to have high growth also tend to have higher momentum. They are better quality. They're not more volatile. They do have a little bit less liquidity at times, and they tend to be a bit bigger. So when you're looking at the overall structure of the global IP opportunity, it should always be a list of names that are familiar and where you have a high level of conviction that the stewardship of the investment that we make on your behalf into those companies is being very well managed. Without getting into a long dissertation, for those that are interested, the approach that we have adopted since inception is beautifully captured by probably one of the investment industry's great writers, Michael Mabusson. He's a professor of finance at Columbia Business School. And this is a fairly recent book. I think it was published about 2 years ago. I first started reading Mabusson back in 2000, and that amplified the work that I'd done on the price formation process as part of my master's thesis. And I got to understand after many, many years of trying to do what everyone else was doing, and that was forecasting that it wasn't going to lead to the sort of results that we have presented here today. And Mabusson makes two very simple points. Expectation investing is based on two simple ideas. Firstly, you can read stock prices to estimate the expectations they imply. In other words, work out from the share price what the market is seeing and spend a lot of time thinking about that. And then secondly, the rider, which is a little bit more challenging, is you will earn superior returns only if you can correctly anticipate the revisions. It's a whole presentation in itself how this is unpacked. But in essence, what we're looking for is we use the market as guidance as to what it expects. We spend a lot of time trying to understand that expectation, and then we spend a lot of time looking at how those market expectations change. So where are we at the moment? I think we all came into 2025. We've seen lots of these sort of posts. Certainly not going to take you through them. There's trade, there's health, there's energy, there's tariffs. How do we put it all together? I thought a simple diagram would do. There's quite a superb paper by Stephen Mirren from Hudson Bay Capital. Bit of brief history. Stephen Mirren was the advisor to Trump in his first term, and he's written a paper called A User's Guide to Restructuring the Global Trading System. And the essence of the paper is very simple to understand. The US is the reserve currency. The more the rest of the world grows, the more the US is burdened to fund those global reserve assets. It has to run trade deficits. In other words, it has to import more than it exports in order for the rest of the world to be able to acquire the dollars that it needs to fund its reserve assets. It leads to dollar overvaluation and currency adjustment, where emerging markets and other currencies that are all pegged to the dollar can improve their competitive position by simply having a weaker currency. So what does Trump want to do? Trump tariffs, Trump dollar devaluation. These are the two key areas of focus in resetting the balances that Trump believes to be unfair in a world that has favored many other countries in terms of security burden, currency depreciation, etc. Just to put two quick charts to it, you can see how from the 1970s, the US has given away its manufacturing base, mostly to China. The services component of the industry has done very well, but you don't fund the rest of the world's currency requirements, that is their reserve currency requirements, through services. You fund it through the balance between exports and imports. That's problem number one. Problem number two is you can see the structural issue around the trade deficit. And effectively, Trump has come in and said, I don't believe this is sustainable. The US is running massive budget deficits. Their debt to GDP is much worse than South Africa. And he's going to fix the problem. Terence would be better positioned to comment on how he's doing it, but certainly it's introducing a lot of market volatility. Stepping back to a bit of good news, the US economy is not in bad shape at the moment. The red line shows you personal consumption expenditure after we had the first interest rate inversion where everyone thought we were going to go into a recession. And the shaded areas show you the cycles, previous cycles. The red is the current cycle since about 2 or 3 years ago. And you can see the US economy is very strong. But there's a little catch. We think inflation is going to tick up. I hear a lot of comments, the most recently from Musk, who seems to have become an economist, that if you cut fiscal spending and you decrease your money supply by less than your growth, you're not going to have inflation. Trade wars create inflation. Canada put tariffs on last night. The US put tariffs on. There's no happy ending to this party. And so you can see the inflation forecast in terms of our own modeling has moved from the blue line to the yellow line, and that's not great for equity markets. Where are we in terms of the macro time clock? We've created this little clock that shows us where we're at. In very simple terms, we use the bond market as a measure of whether we're in tight or loose monetary conditions. And then we use the VIX index, the standard VIX index, CBOE VIX index, to show how much risk the market is pricing in at the moment. And our concern is that having moved into a growth environment in the sort of Biden administration through massive stimulus, we're now starting to see the first signs of the VIX moving higher and the environment potentially becoming a lot more fraught with uncertainty. So we think we probably have seen the peak of the good part of the cycle. Magnus, just sort of in closing, before we look at the position of the portfolio, the core thing that worries us if we take volatility to account is that it has been trading at a very low level historically. When one listens to commentators on investments around the equity market, we think they start at step 2, earnings and PE. How much is the S&P going to grow by? 12 or 13%. What should the PE be? 23, 24. Multiply the two out, you get a level. We think there's a very important step that you've got to take before that. And that is you've got to look very carefully at the liquidity environment. Is liquidity becoming more constrained or more expansive? It's gone from being very expansive under Biden to very constrained under Trump. And secondly, is the risk of something going wrong increasing or reducing? And our judgment would be that the risk of something going wrong is increasing. The VIX index is up at about 24, and the significance of the graph is the black line versus the pinkish colored line. The black line shows you how much margin of safety you have of being invested in US equities versus bonds. At the moment, you have no margin of safety in US equities versus bonds. In a more technical sense, the risk premium on equities is 0 versus bonds. You get the same yield on equities as you get on bonds. So what worries us is you can see that in all cases where volatility increases, the equity risk premium expands. It's the inverse. And we think that even though the underlying earnings of the S&P 500 is still quite solid, The issue that concerns us at the moment is has to do with volatility increasing and equity risk premium pricing in a higher level of uncertainty. But market doesn't know where the world is going from a macroeconomic point of view. Equity investors will demand a higher risk premium, just as companies would demand a higher return if the project was risky or uncertain. So to our last slide, we have positioned the fund very defensively. Since December last year, we have taken profits in a number of key stocks. NVIDIA is down by about half in terms of exposure. Eli Lilly doesn't even appear on the top slide. In November, Eli Lilly was sitting at about 4 or 5%. And so what we have done from a position size perspective is we have dramatically reduced exposure to any stocks that are highly geared to the market. We've brought in Berkshire Hathaway as the top holding. We haven't held Berkshire Hathaway in the portfolio ever. And so that's an indication of how we believe the orientation of the portfolio needs to adjust in the ultra short term to cope with this risk environment that we're in. We've got a lot of cash in the portfolio, 20% in dollar cash. And essentially, we're not preparing for the stormiest of weather, but we are preparing for slightly stormier weather, choppier waters. Magnus, on that note, thank you. I'll hand back to you.
Tony, that was great. And ladies and gentlemen, as you can see, why Tony is managing a great deal of our clients' money through the IP Global Opportunity Fund, which is only accessible via the Brenthurst offices. He's a cool head. He's not prone to making outrageous claims and statements, very analytical, and his performance over 10 years, over 7 years, over 5 years, over 3 years has proven that this is a steady hand on the money of our clients. And I think, Tony, I agree with you that the market is already coming off the boil. The S&P 500 and the NASDAQ was extremely overbought. But those are not the calls that ordinary investors make correctly. They always get it wrong. And that's why Tony's been so successful. We've got so many questions coming through, but I'm going to select two. One is directed at Terence. Terence, I've got a question from Anonymous saying, are you aware of any farm that has been expropriated or bought by government that has been managed successfully by the subsequent owners? Are you aware of any such, or are we being too alarmist about this?
Look, it's a tough question. That yes, there are some success stories, not enough. But you know, there's sort of a you have to disaggregate. Okay, well, how was a particular property come? How did it come to its beneficiaries? What are the terms under which it's being managed? Look, as I say, there are different aspects to the land reform process. If it's a restitution case, invariably it goes through some sort of community property organization or trust to a community that was dispossessed, 70, 80 years ago. These people they don't have the generational skills. And there's a sort of assumption that, which I think is very condescending, that, oh, well, if you've got nothing else to do, go and farm. Like, it's easy. And these often break down because even the community is not as cohesive as might first seem to be the case. They are not given sufficient post settlement support, and people drift off and have conflicting interests. Redistribution, which is for the guy who actually wants to get a parcel of land to farm but doesn't have an historical claim, I think those tend to be a little more successful. But one of the things that really holds it back is that it has been contrary to state policy to actually provide any sort of title. So that can't be leveraged. And also, just understand, farming is hard, and I don't think. Interestingly, where we have seen a spike in polling interest in the perception of the most pressing issues facing South Africa, you often find that it's in urban areas where people start to say, well, this is something we've got to get right, or things will fall apart. And I think it's often, well-meaning suburbanites responding to what they perceive to be the issue because that's what's being spoken about in the media. For the most part, South Africans do not want to work in farming, and I think that we would be well advised to actually stop this obsession with how many percentage, what sort of percentage is owned by what group or whatever, and actually have proper support to provided to young farmers of all races to actually get them productive. Because another factor is that our farming community is aging. And that's happening all over the world. It's not a glamorous profession. So let's give the support to those guys who want to go into it, understanding how tough it can be. But yes, look, there have been a few successes.
I can just add before we go on to the next question. In our practice, I've come across about 3, maybe 4 instances where farmers, their farms were bought by the state, whether under duress or voluntarily, and in the end, they ended renting back their own farms to farm, and the community was just happy to receive a rental income and spend the rental income. And now that's fairly common, and it tells you something, that farming is difficult. You need the skills, you need the capital, and the experience. So, Tony, a question to you. Sorry, Terence.
Yeah, please.
Thank you very much for that answer. Tony, one last question before we wrap up. The question came through from a viewer. Should I sell out of the Nasdaq, S&P, and move to your fund where there's more downside protection? The reason why I'm asking that question is a lot of people manage their own funds. They tend to be late to the party, either when the market goes up or the market goes down. Now, I know, and I'm partly responsible for advising people to buy the S&P 500 and the Nasdaq, but there is also a time to be giving your money over to a safe pair of hands who follows the markets and takes preemptive steps, like you've done with your very high allocation to cash, which I've noticed the last 3 to 4 months. And now you look like the smart guy, but these things take time. It's like the old saying, Brian O'Banner became a very successful rugby player, not because he was running where the ball is, but where the ball is going to be. And that applies in the investment world. Everybody's running after where the ball is, and you're always gonna miss the ball. So just one final question before I wrap up with some recommendations for the viewers.
Magnus, it's an interesting question. I'll answer it in an interesting way. Firstly, I don't have a PA portfolio. I focus all my energies on client portfolios, and I co-invest. The reason for that is that in investments, it's very difficult to get emotionally attached to the market because it introduces the concept of regret. At what point do you sell? How much do you sell? Do you have the tools to manage your risk? And do you understand the risks that are underlying in an index? I think one of the things that we have been able to demonstrate over time through both IP Opportunity and Global Macro and the other funds that we run is that on a risk-adjusted basis, we've delivered significant returns above the index, but at about 70% of the risk. For those on the call that know me well, that have journeyed with me, you'll know me to be an extremely risk-averse individual. I don't take particularly large bets, and we've got very sophisticated tools within our framework that allow us to better understand where the risk resides in the market. And I was captivated by Terence's talk today because I spend virtually no time trying to understand the politics. I'm particularly poor at it. And, putting it into the correct framework carries with it a huge amount of value in order to be able to assess the merits of information that come across the screen, as we've done today with what Trump is doing. So in that context, Magnus, I would say that while one has benefited significantly from being in an index fund, there certainly are significant parts of the market that are still doing extremely well that we've captured in the portfolio, but we have the additional benefit to your clients of aggressively managing that downside risk. And that's why I don't have my own PA portfolio, and that's why I co-invest in the funds.
Thank you very much for that. I'd like to thank Tony and Terence, but before I wrap up, let me just give you some practical advice for people who have been watching this presentation. First of all, I need to remind viewers as to what Bell and Terence Wealth does as a company. We survive on one thing only, is to give good, honest advice to our clients with the outcomes or the best possible outcomes in mind. Nobody else pays us. Secondly, we're probably the largest independent advisory group in the country. We've got 9 offices, we've got 23 very qualified financial advisors, and they wouldn't be working for Bell and Terence if they do not care about the outcomes for their clients and their families and their children. That's the ethos, that's the real driving force of our company. We don't work for one of the big asset managers who just to sell any product that's out there on the market at the fastest rate possible. To summarize, I would suggest after this, go and make an appointment with one of the investment advisors and Bell and Terence around the country. No, go and sit and chat. They will advise you. They spend a lot of their life looking at markets and doing what we do. But let me summarize what I would be doing, listening to Tony, listening to Terence and other people. First of all, realize that South Africa is in deep financial trouble. It is at a inflection point. Many commentators like Dr. Frans Cronje, Dr. Stephen Bruce from the Financial Mail, who said last week, the South African economy is uninvestable. And that's quite a statement for someone who's very, very prominent in the media, and he's been very pro the ANC for many years. And there are many, many people are saying, guys, we are in real trouble. Now, you can do nothing with your mentions, ladies and gentlemen, and hope for the best. But hope is not an investment strategy. And everybody's got to go and sit and listen and analyze our situation, saying, what do I have? What can I do? What can I do to protect myself? Because the rules are changing and we do not know what the outcome is. Unless the ANC changes its ideologically driven policies very, very dramatically. And if that's what you want to believe, then South Africa might recover, and quite dramatically so. But I don't see it. And if I do see it, I will talk about it. But I get the impression that the ANC is hell-bent on carrying on with cater deployment, with BEE, interference in the economy, getting as much control over the economy as they can, even at the cost of greater damage to the economy. And if that is the scenario that you believe, you need to consider making drastic moves to your asset allocation in terms of where should my money be. Number one, the 1 million rand single discretionary allowance that you're permissible every year is the first step that you should consider. And I need to remind people that when this allowance was introduced 10 years ago, your R1 million could buy $84,000. Today, the same R1 million has never been adjusted. It's never been adjusted, only buys you about $50,000. So your purchasing power has already dropped by 30 or 40%. Plus, there has been dollar inflation elsewhere, so you're buying even less in real terms. So the single discretionary allowance of up to 1 million is the first place to be. Take money, take it offshore, deal with someone like Bell and Terence, do it yourself, but get your money offshore into a structure. In Guernsey, we use Momentum Wealth International for our platforms, and we invest in Tony's fund as an example. Point number 2, if you are 55 years or older and you can access your retirement funds whether it's in a retirement annuity fund or a provident preservation fund, consider very, very strongly to pull your money out. And I know this is not what the typical insurance broker will tell you, but my advice has been take your 1/3, get your money out tax-free as quickly as possible, remit that offshore, and move the balance into 100% offshore allocation living annuity. There's another step, very practical. Thirdly, if you don't have money that you can take offshore, you can make changes to your portfolio domestically, move that into asset allocation funds, as we call them. These are rand-denominated funds that the fund manager like Tony can take and buy dollars, but it comes back into dollars. That's another way to protect yourself. Gold has been a very good protective measure over the last couple of years. And believe it or not, I'm going to say you can, even with a small portion of your money, consider Bitcoin or any one of the other types of artificial assets out there. And then lastly, if you're still hanging on to, especially in the northern parts of the country, hanging on to so-called rental property as an investment, it's not going to be an investment. It's a terrible investment. It's been a disaster. Sell it, get some money, and protect yourself. And once again, you're welcome to email us at Brentis, make an appointment, have a cup of tea. You will get honest advice and independent advice. I would like to thank Terence from the IRR. Guys, make a contribution to that institution. They are funded by the public. They've been criticizing governments for 100 years. Carry on with that, Terence, and thank you for your contribution. Tony, as always, your fund is doing very well. We sleep at night knowing that you're in charge of that. And to our marketing team who put this together, Darlene and Sue, and to everybody out there listening, thank you so much for watching. More than 400, 500 people are still watching, which is fantastic. They haven't fallen asleep yet. Things are very, very uncertain, but at least we're giving you the facts to make some good decisions for your futures. Thank you very much, and goodbye to everybody.